All right. How you all doing today? Okay. Today, let me see if I can not show the fan of the ceiling. Okay. Today, I'm going to be talking about chapter 2. And as usual, I have my PowerPoint presentation. Also, I can look at it here. Chapter 2, analyzing and recording business transactions. Okay. Now, if you remember, I was telling you in the previous recording. I just want to, before we proceed, I want to apologize. When I was showing you at the end of the previous step, when I was showing you the statement of owner's equity, I referred to it as income statement. So I apologize for that. It is a statement of owner's equity. Okay, now let's go back to our chapter 2, analyzing and recording business transactions. Like I said, the financial statements do not come from space. There are steps that have to be taken to get to the financial statements. And the very first step is analyzing and recording business transactions. Now, like what we said, your daily activities, the buying and the selling, payments of cash, receipt of cash for whatever purpose, all of these are your business transactions. So they all have to be reflected in the financial statements, whether it is in the income statement, statement of owner's equity, or the balance sheet. Those are the three financial statements. All of these business transactions have to be reflected in it. So that's how you get a picture how your business is doing through these financial statements. So the very first step is analyzing business transactions. Like we said, analyzing and recording. We have, before I continue, we have two books that we must learn. The first book is the General Journal book. The General Journal book is where we record the daily transactions. So we may record for 2 weeks, and then we have to, at some point, for example, cash. After 2 weeks, you want to see what the balance in cash. So you have to have a summary for the cash account alone. Or you may want to see your balance in accounts receivable. You may want to see your balance in your supplies. So these, when you summarize the activities that related to each account separately, that is recorded in a different book. So we're going to pick from the General Journal all the activities that belongs to that specific account, this cash, the receipts and payments of cash. We're going to put them in a summary for cash alone. That is called the General Ledger book. Okay, so we're going to learn both of these. Yeah, if we have to come up with the financial statements. Okay, so like we said, the business transaction is your economic activities that should be recorded in your accounting records. Okay, we have, before we record, we have some guidelines for recording. You cannot just come and start recording. We have some guidelines that we must abide by, and we must know. The first thing is you got to understand the issue of recognition. Recognition means recording. So there are some transactions that are recordable in the General Journal, and some transactions are not recordable. So the issue for this is that if a transaction took place, there is a receipt, payment, it is recordable. For example, if I go on the phone and I ordered um, 2 dozens of pens, just got on the phone and ordered those. Should I record that? No, this is not recordable. But when I receive the pens and I get the receipts and sign it, that is recordable transaction. Okay, so that's the issue of recognition. There are transactions recordable and transactions non-recordable, and the bottom line for that, or the guideline, is the receipt and the transaction must have taken place. Okay, and let me see if I. Okay, a little bit better. All right. We're just learning through this recording. Okay. The second issue, valuation. When I say I received a dozen of pins, okay, I can't record in the general journal that I debit 2 dozen of pins. You can't do that. You have to do it in monetary terms, in terms of any currency. It could be cash. Sorry, it could be U.S. dollars. It could be Jordanian dinars, Japanese yen, etc. Okay, there should have been a monetary transaction, yeah, monetary units. The second issue is that we got to learn is the issue of classification. Okay, the issue of classification. Now, when I say I received a dozen of pins that I ordered last week. Okay, all right. So this transaction, we have to do some classification in which pins I received the pins, for example. Yeah, what kind of account is a pin? It's an asset, or you could say supplies. Okay, so we're gonna say that means supplies increased. Okay, supplies is part of the balance sheet. If you remember, when we talked about the balance sheet, it says assets equal liabilities plus owner's equity. So pins are assets. So when assets increase, I mean, we got more pins, the assets were increased. And then how did I pay for those? Did I buy those pins on credit, or did I pay cash? If I pay cash, the cash is an asset. So I have two assets, two classes of accounts here. Two classes. I have assets. Cash, if I pay cash, that means it's an asset. If I didn't pay, I bought the pins on credit, that means I have a liability. Okay, liability also is a balance sheet account. We're going to talk about in a little bit about the increases and decreases of these different components of the balance sheet and income statement. Okay, but that is the issue of classification, is the process of assigning all the transactions in which a business engages to appropriate categories or accounts. To appropriate categories. For example, we say the category of assets. Okay, but you cannot say I debit assets. Now, assets have accounts in them. Liabilities also have accounts in them. So which specific account in assets and which specific account in liabilities or owner's equity that has been included or affected as a result of this transaction. Okay? All right, here is the principle that accountants depends on when they record the transaction. It is called the double entry system. We have to, when we record transactions in the general journal, we have to follow the double entry system. Now, there are two things. When we say double, that means there are two things, two accounts. All right. So the definition of this, and I'm reading it from here. Each transaction must be recorded. Each transaction must be recorded with at least one debit and one credit. Two, double. Each transaction must be recorded with at least one debit and one credit, and the total amounts of the debits must equal the total amounts of credits. Okay? So when we say double, that means two sides, two things. That's what. For example, if I say I purchased a dozen of pens and on a credit, let's just say on a credit. Don't forget the issue of classification that we talked about earlier. First thing, you look at the classes of the transaction. You have to assign the transaction to a classes. We say supplies. The pens are supplies. Supplies is part of the balance sheet, is an asset. And then the other issue is credit. Credit here in this case means liability. If I purchase anything on a credit, that means I am creating a liability. Okay, so you have when I purchase a dozen of pens on a credit, okay, I based on the double entry system, okay, I have two accounts. One, at least one must be debit, one account must be debited, and an account must be credited. Okay, the two accounts in this case are going to be the assets. Okay, remember the pens are assets, and then the purchase on a credit. Credit is a liability. Now we got to be specific. You can't just say I debit assets. What particular asset was that? It is supplies, for example. So that's very known. So the supplies, and on the second one is credit. You can say credit, and we know it's a liability, but what specific liability it is? It is accounts payable. Okay, so these are the two accounts, supplies and accounts payable. That's how we record. We will have account for supplies, we will have account for accounts payable. You can say assets, debit asset, but you have to be specific in assets. In this case, we talk about supplies. And also you can say liabilities, just liability like that. You got to be specific in liabilities. In this case, it is accounts payable. Okay. So since I'm talking about accounts, okay, like I said, accounts are the basic storage units of accounting. The basic storage units for accounting data, and are used to accumulate accounts for similar transactions. Okay, for example, cash, accounts receivable, notes receivable, supplies, building, equipment, all of these are accounts. Okay, that's why you have to, some corporations have a big list of accounts. They may have 100, 200 accounts, 300 accounts. So, but of course, they fall under assets, liabilities, and owner's equity, or under supplies, under revenues or expenses. In expenses alone, you may have 4 or 5 accounts. Okay, you may have supplies expense, you may have utilities expense, you may have sellers expense, you may have tax expense. Okay, and so these are the accounts. Okay, and that's how you measure your transaction. You have to have accounts. Okay, all right. So, as I mentioned earlier, let me see if I can get. We have to be familiar with. Okay, I'm sitting next to the window, I'm looking outside. I heard a big sound. I've got to show you how the general ledger, general journal looks like. Just for a moment. Maybe you're going to look for that in. Okay, just maybe a little bit earlier for that, but I just want to show it to you. Okay, here you have the name of the business, name, and then, okay, this is your all page. This is your page. Okay, here you have one column. You have date, and here you have transaction or accounts, and here you have two columns, one debit and one credit. Okay, you have the date, you have the transaction or accounts in the middle, transaction or accounts, and here you have debit and credit. That is how the general journal looks like. Of course, it can be a lot fancier than this. Some people may put for the date one column for the month, one column for the day, make it look fancier. Okay, but that's the generic form of if you can read it. Okay, this is debit, this is a credit, DR, CR for credit, DR for debit, CR for credit. Okay, all right. That's how the general journal look like, and in the general journal we record daily transactions. All right, we record daily transactions. Okay, what is a very helpful also in recording daily transactions is to do a T account. T account. It's called T account because it looks like the letter T. Let me just do that for you and show you how's that. It looks like the letter T. T account. Okay. You're going to do a letter T like that. You're going to put the name of the account on the top. When I say account, that means either whatever account it is, whether it's a liability account or assets accounts, revenue accounts, expenses account. If it's an asset account, that might be cash, accounts receivable, notes receivable, prepaids, supplies, land, building, etc. If it's a liability account, it could be accounts payable, notes payable, salaries payable, utilities payable, like that. Yeah. The left side is debit, DR, and the right side is credit. Okay. The left side is debit and the right side is a credit. Okay, that's the T account. For example, this is you could say that the lazy person, if they want to see Let's say after a week of work, I want to see what's the balance in cash. Okay, I do a very fast T account and then I put for the title, I would say cash. Okay, I would say cash. I know it's a lousy handwriting, so bear with me for that. So the title would be cash. Okay, cash is an asset. Okay, when assets increases, they are debited. When assets decreases, they are credited. So if I did some work and I collected cash, let's say $200, okay, I would have to put the $200 over here. Okay, if I use the cash is an asset. When assets are used, they are decreased and they are credited. So let's say I used $50. All right. So what is my balance in cash now? I started with 200. I use 50. So which side is larger? The debit side is larger. So the balance in cash is $150. Okay, I collected 200 and I use 50, and the balance becomes 150. Okay, 150, 150. It's natural for the cash to be on the left side, on the debit side. If you ever see cash or any other assets, the right side is larger than the left side, that means you are in the hole. It makes no sense. All assets, whatever they are, their normal balance should always be on the left side, on the debit side. All assets. Let me write these rules for you. Okay. Assets. All right. We always say this is the left side, DR, and the right side of the T account is CR. Okay. For all assets, listen to me carefully. All assets, regardless what they are, cash, supplies, accounts receivable, notes receivable, truck, land, building, equipment, machinery, shelves, computers, pens, pencils. So when they increase, they are debited. When they increase, they are debited. So all the increases in assets, they are debited. The decreases are credited. The minuses, when I say credited, so assets, when they increase, they are debited. When they decrease, they are credited. All right, that clear? All right. Liabilities. Let me write down one for liabilities. Can you read it? Liabilities. Liabilities. Of course, the left side is debit. This is a T account. The right side is credit. Now, give me an example of liabilities. I'll give you a second. Think about something you owe. Liabilities. Accounts payable, notes payable. I keep saying accounts payable and notes payable, guys. What's the difference between the two? between accounts payable and notes payable. Notes payable, it has to be paid within a specific time and date. Sorry, but within a specific date. It could be, it's a promissory note. If you owe, as a result of doing business, some people may make you sign a note that you have to pay them within 90 days plus interest. That's the key. Notes payable is a promissory note that has to be paid within a specific date plus interest. Okay? Accounts payable does not have a specific date or interest in it. Yeah. Okay. So that's why I keep saying accounts payable, notes payable. Yeah. Anything payable. When liabilities increase is the opposite of assets. When liabilities increase, they are credited. When they decrease, they are debited. All right? When liabilities increase, they are debited. When they decrease, they are credited. All right. What's left? All right, we have owner's equity. Under owner's equity, we have 4 accounts. Remember, under owner's equity, remember the formula we did yesterday in chapter 1, beginning balance of capital. That's when you start the business, plus net income minus withdrawals equal ending balance. And if you remember, also we said we can replace the net income by saying beginning balance of capital plus revenues minus expenses. Oh, we forgot one more, additional investment, if any. So let me go back. Beginning balance of the capital plus net income plus additional investment, if any, minus withdrawals will give us the ending balance. Or you could say beginning balance of the capital plus revenues minus expenses plus additional investments, if any, minus withdrawals, give us the ending balance of the capital. So we have under owner's equity, we have capital, we have revenues, we have expenses, and we have withdrawals. Okay, under capital, under owner's equity, we have 4 accounts. We have capital, revenues, expenses, and withdrawals. Okay. Capital is treated like revenues. And treated like revenues and liabilities too. When capital, okay, these are 2 accounts. Let me just put debit, credit, debit, credit, debit, credit, debit, credit. When capital increase, it is credited. When it decreases, it is debited. What increases capital? Revenues. What decreases capital? Expenses and withdrawals. Revenues. When they increase, they are credited. When they decrease, they are debited. Expenses, when expenses like assets, you treat them. When they increase, they are debited. When they decrease, they are credited. Withdrawals. When they increase, they are debited. When they decrease, they are credited. So, based on what I'm seeing here, assets, expenses, and withdrawals are treated the same way. Assets, expenses, and withdrawals treated the same way. When they increase, they are debited. When they decrease, they are credited. Okay. Liabilities, revenues, and capital treated the same way. When they increase, they are credited. When they decrease, they are debited. Okay? These rules are in the textbook. And let me see which page. These rules are on page 45 of the textbook. On page 45 of the textbook. Let me show you. This is the textbook. This is page 45 of the textbook. You can see them there, nicely put. Definitely better than my handwriting. Okay? So here you have your T accounts and the rules and everything. All right. Okay. Let me just mention one more thing here is the normal balance. What does that mean, the normal balance? Is in accounting like where the account starts and increases. That's the normal balance, where the account starts and increases. For example, cash. Cash, when we start the business, we have to contribute cash. That's owner's equity. Remember, we said there are contribution from you or from liability. You borrow money, yeah. And both together will equal your assets, yeah. So cash starts on the debit side. That means it's increase when it's cash of the business starts on the debit side and increases by debit. So the normal balance of cash should always be debit balance. If the cash account has a credit balance, that means you are in the hole. Okay. All assets, normal balance should always be on the debit side. All assets, that's their normal balance. Okay, that's where the balance should be. If I ask you, what is the normal balance of the following accounts? Okay, and I put supplies. Think about it. Supplies is an asset. When it increases, it's debited. That means the normal balance of supplies should always be debit. If it's unusual for all assets to have a debit credit balance unless you are in the hole. Okay, unless you are in the hole, yeah. So that's the idea of a normal balance. Okay. You need these rules, guys, for let me see if I still have the syllabus. Just give me a second. Principles of Accounting 1 syllabus. Principles of Accounting 1 syllabus on the guidelines. Okay, chapter 4, problem 10. Okay. On your guidelines, chapter 4, problem 10. Chapter 4, problem 10. You're going to be needing these rules when you record your transactions. Okay, problem 10, chapter 4. Let me see. Chapter 4, Okay, chapter 4 starts on page uh, chapter 4. It starts on page 131 of the text. Chapter 4. And the problem 10 is problem 10 is page oh no, it's let me see. What did I say? Let me look in the syllabus one more time. Just bear with me for a second. Chapter 4. Problem 4. Okay, I'm in chapter 5. No wonder. Chapter 4. Problem 10. Chapter 4. Problem 10. Oh, okay, I got it. Okay. Chapter 4, problem 10 is page 165. Okay. On June, let me just read the introduction. On June 1st, 2014, Bob Lutz opened Lutz Repair Service. During the month, he completed the following transactions for the company. Okay, we need for that problem, we only need 1 month only. Okay, guys, 1 month only. Requirement number 1 says, because the syllabus saying, okay, let me go back to the syllabus. Okay, week 1, requirements 1 and 2 are required. Requirements 1 and 2 are due. Requirement 1 says prepare journal entries to record the June transactions, include the post reference column, and fill in the accounts numbers listed in requirement 2. So, when you say prepare journal entries, that means we're going to record those transactions. Those are business transactions from June 1st to June 30th. Those are the ones that we need to record. So requirement 1 and 2. Requirement 1 is prepare them. That means you record them in the journal like I showed you earlier. Prepare journal, that means, for example, June 1st, began the business by depositing $20,000 in bank account in the name of the company. See, now this is the cash of the business. Remember, going back to the issue of classification, recognition, is this a recordable? Yes, of course it's recordable. The transaction is taken place, and now the money belongs to the business, the cash. So now, depositing 20,000. So what are remember the double entry system that we talked about? Every transaction has 2 sides, one side with at least 1 debit and one side with the credit. So the 2 accounts that I'm seeing here, okay, the cash is definitely one of them. And what is the other one? Remember when we said when we start the business, that's the beginning balance of capital. So the 2 accounts are the capital and the cash. The capital, which is Mr. Lutz's capital. So now they're going to go back to the rules of those 2 accounts. The capital, did it increase or decrease? The capital increased. How about the cash of the business? Not his personal cash, the cash of the business. Did it go increase or decrease? It's increased. Now, how do we record it in the general journal? When it says prepare journal entries, that we are talking with, that means recording the transaction into the general journal. Recording the transaction in the general journal. Cash is an asset. The cash of the business increased. When assets increase, they are debited. So that means I have to debit the cash of the business. The capital also increased. Remember, we said when the capital increase, it is credited. So I would have to debit the cash and credit the capital. Okay, you all with me? So let me just do that for you. I just want to remind you of those rules. Again, under owner's equity, we have the capital. When capital increase, it's credited. When assets increase, they are debited. So the cash of the business increased, I would have to debit the cash, and the capital of the owner increased, I would have to credit the capital. So if I want to do a journal entry here, this is a very small general journal page. Okay. This is the date, account or transaction, debit, credit. Very small journal page. So on June 1st, 6/1, June 1st, I'm going to debit the cash. So I put the cash over here. And where should I put 20,000? Should I put it under debit or credit? I'll put it under debit. 20. Oh, boy, that doesn't. 20 grants. I know you can't read it definitely, I'm sure. I'm sorry. 20 G's. 20 G's I put over here. And what do I credit? The capital. The name of the guy is Lutz. Lutz, L, capital. And where I put the 20,000, under debit or credit? I put it under credit. Remember? It increased 20 G's. 20 G's. Let me clear the page. Maybe it will look a little bit better. Let me clear the page. All right, let me do a general journal page. All right. Date, account, debit, and credit. See that? Date, account, debit, credit. So the cash is, this is June 6th, 1st on the date. Cash under debit 20 G's, 20 grants, and Lutz capital 20. Notice on the left side I put the cash, on the right side I put, okay, and so that is the 1st of June. All right, guys, so I did one for you, and you got to do the rest of those. That's requirement number 1. You got to record all of these transactions. Okay, page 165. That's due week 1, guys. Let me show you. In the textbook, page 165. This is the problem. You see it? Problem 10. Requirement 1 and 2 are due the first week. Okay, if you want more understanding and more in-depth analysis of how to record business transactions, go to chapter 2, pages chapter 2, pages 48. Pages 48 through page 54. Okay? 48 through 54. There are lots of transactions. So the first one on problem 10, guys, is very similar to replica almost. On page 48, the first transactions. See how they recorded it, guys? See how they recorded it? The yellow? Okay, the yellow. The yellow is where it's recorded debit and credit, debit and credit. I want to show you how the book put the general journal page. General journal page. Okay. On page 66. On page 66, there is a general journal page. On page 66. There it is. You see it? That's a general journal page. Solutions. That's a general journal page. That is what you need to do for the problem. Requirement number 1. Very similar to this one. Okay, I hope I helped you on this. I'm giving you the secrets now. Okay, there is a practice set. There is a practice set, guys, that you need to study. Practice set on page 66. And you have the solution, guys. You see, page 66. And then you have the solution, the general journal page. Whoa, and you have T accounts also. Now, let me just remind you guys, if you don't have the book, you are wasting your time. If you don't have the book, you are wasting your time. The book has a detailed analysis. Okay, has a detailed analysis. You got to be patient. Accounting needs patience and needs time. Okay, so if you don't have the book, you're wasting your time. I'm just being honest with you. Get your book today. Get the ebook. Okay. All right, everyone. Have a blessed day, and I hope I gave you some analysis for today, and I got you prepared for the problem requirement 1 and 2 that's due week 1. Guys, yesterday was the very first day, week 1. So start working. All right. Have a good day, everyone. I will put this videotape on the first page of the course. Have a good day. Okay, let's end the stream and end.